Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to update our monthly and annual dividend income and give an update to our portfolio value. Every single month, I do give an update on my portfolio, so let's update our annual dividend income, our monthly dividend income, and our portfolio value. So there you go. There's the new numbers for July 1st, and there's last month's total dividends. So in annual dividend income, we are up from $82.60 up to $94.64. In monthly dividend income, last month we received $1.62, and last month was a lot bigger at $13.13. And then in portfolio value, we went from $2,352 to $2,643. So overall, these are the first 3 or 4 months in the portfolio, and you can see how it has performed so far. Now, the dividend income will be updated at the end of July because we are currently at the beginning of July and we have not received those dividends yet. We've only received one, but so far, I'm sure that dividend will not be as high as $13.13 because that month is especially higher compared to others. But you can see what I get paid on an annual basis from all my stocks here over on this little category, and this was changed from last month of May over to June. So we will be giving an update next month. But overall, guys, if you're new to the channel and you are wanting to learn how to invest in dividends and you're interested in supporting my channel and you're interested in getting started with M1 Finance, go ahead and use this link in the description right here. It's in the description of all of my videos. And speaking of description of the videos, there are other materials there as well. There are links to credit card referrals, to mentoring programs for your portfolio. So go ahead and just check out the description. There's all different types of things there, but you can get $10 just for getting started with your portfolio. Be the 17th person that uses my successful referral link so I can shout you out in the video. But overall, guys, the portfolio is doing very nice. And those of you that watch my content know that every single month I give an update on my dividends as well as my entire portfolio. I'll break down each stock one by one. The main reason I want to do this is I just want to give updates on how my portfolio changes every month because the stock market changes every single day, and I also want to give you guys insights on how I feel individually about each stock. So you're welcome to leave any comments down below about any questions you might have about an individual company that I have, new moves that I made in the market, or just any questions for me in general. I have an email address down there if you want to reach out to me directly. But overall, guys, we are doing very good in the portfolio. We are up 20.23% on a money-weighted return. On a time-weighted return, we are up 14.44%. But on the money-weighted return, we are up 20.08, and we are up 377.64 in total gains. 354.20 coming from market gains, and then $23.44 coming from earned dividends. In the month of June, we did add some new stocks and sell out of some old stocks. So if we go to my activity here, and then we click trading, and then we go to the month of June, you can see that we had 3 different sales. We did sell out of MAA, and we reduced our position in IBM and AT&T, and we replaced that with WP Carey and Store Capital. I will be going over those again briefly as we go through my portfolio, but nothing changes a whole lot in my portfolio. Every now and then, about once a month or so, I might change the weighting of one position or buy a little heavier or sell piece of one company, depending on where the company goes and where the market's at. But overall, my portfolio does not change a lot, but I will give an update on where these stocks are based on their price and their performance in this recession. The biggest winners in the portfolio are still some of the same names. We have Discover, Whirlpool, Apple doing very nice. And then our biggest losers in the portfolio, we are down on 4 of our 31 positions. And we have the Southern Company, Store Capital, WP Carey, and Starbucks. 3 of these 4 are newer positions. And then we are up on all the rest of these stocks. But let's go ahead and get started, starting with the number 1 stock in my portfolio based off the amount of money I put into it. We'll be sorting by value. So let's get started with Broadcom. Broadcom is a stock that I think is very, very successful in the long run. They have almost a 4% dividend yield. It's right at about 4%. And for the long run, I think that this company is going to do absolutely fantastic. The dividend growth is great. The balance sheet is healthy, and they have the number 1 customer in the world, Apple, behind them, and they are a semiconductor company creating microchips for 4G, 5G devices, and other products as well. Overall, this is a tech company that I see that has a very rare high yield that is still safe. Most of the companies like AT&T and IBM, for example, companies that I sold part of my position in, I think they are at a very high risk of cutting their dividend. Their CEO of Broadcom has said that they will be keeping that dividend almost no matter what, and they're not anywhere being near close to cutting it because they are still very profitable. But with Realty Income, we're up 36.82%. It's 7% of my portfolio. And those of you that don't know Realty Income, if you're interested in investing in real estate, specifically real estate investment trusts, this is the arguably best stock that you can invest in the stock market. It is very well run. I made an entire video talking about WP Carey and Store Capital and why I'm adding them, and they essentially do the same thing that Realty Income does. They are a net lease real estate company. They invest in real estate properties where they don't have to pay the taxes, the maintenance, a lot of the fees that come along, and they basically just provide the building and the insurance, and they primarily focus on investing these properties and then selling them out to large corporations, specifically S&P 500 companies, investment grade, things like that that are extremely high quality, and they get a large part of their rents almost every single time. They have a massive yield, they do pay out monthly, and their share price will grow in the meantime. Next up, we have the Southern Company. This is the one that we're down on. We're down 0.45% or 55 cents. It is 6% of my portfolio. This will not take very long to explain. Basically, the Southern Company is just a boring utility company. You can read the description right here. They engage in selling electricity and natural gas to its customers. They are very boring and they do not change a lot, but they have steady dividend growth. Every single year they raise that dividends, including the previous quarter, and the share price will gradually increase in the meantime. You are almost getting a 5% yield for one of the safest companies in the stock market as regards to utilities, so I think it is a great buy if you're wanting to hold for the long term and get guaranteed returns. So Visa is the next stock that we own. 25.18% is what we are up on it. It makes up 6% of my portfolio. If we click on Visa here, you can see that it's just had a gradual uptrend ever since the recession, like a lot of these stocks. It is by far the lowest yielding stock in my portfolio with only a 0.57% dividend yield. I think with Visa, I don't have a lot of growth companies. I primarily focus on dividend companies, but I have a few that have a 1%-ish yield, but are just mainly focusing on the growth of the dividend and the share price. This is one of the few stocks in my portfolio that I can say the dividend is not a super large focus. It is mainly focused on the dividend growth and especially the share price gains. I think with the future potential with growth of credit cards and debit cards keep on being a continual growth sector, and especially mobile platforms growing every single year, I think that Visa is going to be the dominant player and continue to be the dominant player for decades out. So Visa is a stock that I'm definitely going to be holding for a long time, and you can see how the stock has performed in the meantime with that great growth. The next stock up is one that I upped in my position when I first started the channel. It is 5% of my portfolio. It is PepsiCo. I'm up 6.71% on it. PepsiCo did just raise their dividend in the previous quarter from 96 cents up to $1.02. They are almost a 3% dividend yield. I'm not sure why those dividends are not loading in for M1 Finance. That is not right. Okay, well, they have paid dividend streaks for about 50 plus years now, and they are a 3% dividend yield stock. And those of you that know PepsiCo, you all know the name of the brands. You probably use them and drink them and eat them every single day. Things like Doritos and Quaker Oats and Gatorade and all different types of brands that are absolutely dominant in the consumer market. And you can see how the share price has performed in the meantime, up 35% on the past 5 years. Even with this recession, they're completely resilient from most recessions, including this one, and they're continuing to raise those dividends every single year for about the last 50 years. Next up, we have Caterpillar, one that I also increased in my portfolio recently. We're up 18.38% in my portfolio. This makes up 4% of my portfolio, and Caterpillar is a stock that I love. The one thing that people will probably shy away from the stock is that it is extremely sensitive in recessions, and this is why its share price has lagged recently. It has pretty much been flat over the last 2 or 3 years, but in the long run, their dividend grows massively, their revenues grow massively, and there's also rumors of an infrastructure bill passing along, and this is a dividend aristocrat like many of the stocks in my portfolio, and they even raised dividends during the Great Recession. So I think that this stock will be able to maintain its dividend, if not even grow its dividend throughout the recession, and even if it has to cut its dividend, I will still be holding on. With some of these stocks, if they cut their dividend, I'll be selling out of them, or if they're reducing them. With many of these stocks, if they were to cut their dividends to zero, I'd probably be selling out of them, but there's a few of them that I would keep almost no matter what. If Caterpillar has to cut its dividend 10, 20, 30% in this recession, and they're still able to keep that long-term dividend growth, I will happily hold on to Caterpillar because I think the long-term story for this industrial company is fantastic. But next up, we have 3M, which is also 4% of my portfolio. 15.85% is what we are up on it. 3M is a company that has almost a 4% yield. They're about flat over the last 5 years. I think the share price got way too ahead of itself and it's been coming down to earth ever since. It was a $200 and almost $60 stock, and they've had great dividend growth over the last 5 years, just like they have. They are a dividend king. They've raised their dividend, I think it's 56, 57 years in a row, and they produce over 5,600 products. They are an excellent company to hold for the long term when the economy picks back up, and I think that will be a huge gainer and probably one that I'll end up retiring my stock market portfolio on. And speaking of companies I'll probably hold till the day I retire, we have next up McDonald's and Coca-Cola. McDonald's we are up 13.12% on. It makes up 4% of my portfolio. McDonald's is a very long-term growth story on both dividends and revenues. It's amazing to me with how large of an imprint that McDonald's has on our global economy and in the food industry, and that it still grows every year. And you can see the dividend growth is still quite impressive. It was $1.25 last quarter, and 5 years ago was 85 cents, and the share price has almost doubled in the last 5 years. It has a 2.6% yield. I think the share price gains alone will be quite substantial from this company, and those of you that are just looking for growth plays that are safe companies, this is great enough, and the 2.6% dividend yield just makes it even that much better with the dividend growth. So McDonald's is just one of those companies. If you're a dividend investor, I think you got to own it. I think just like with a Coca-Cola and Pepsi, McDonald's is just one you got to throw in there, at least for now in the meantime. But next up, we have Coca-Cola. Coca-Cola, we are up almost exactly 1% on. It is 4% of my portfolio. And with Coca-Cola, it is a struggling stock right now that has barely recovered from the recent lows in the market, but that is great for me because that means we're getting a better dividend yield, and I think that this company will hold its dividend throughout this recession. It went from 33 cents up to 41, and they did just raise that dividend about 6 months ago. It is a 3.6% dividend yield, and I don't need to describe this company. You know many of the brands that it owns, and you can see some of the ones highlighted right here. But Coca-Cola is a company that we all know and love, and in the long run, it will be profitable. It will grow its dividends, and it will be a successful company in the long run. When it comes to stocks that I mentioned, like cutting their dividends to zero or cutting them in half, this is a stock that I would probably never sell. For me to sell a company like Coca-Cola, being as old and as dominant in the consumer market as it is, for me to cut this company out of my portfolio entirely, it would have to be some massive changes in the business model and management that would just make me not want to own this company at all. So once again, this is probably a company that I'll probably own to retirement. And then next up we have WP Carey. We are down 1.24% on. It is 4% of my portfolio, and this is a brand new position in the portfolio. We can see that we added it June 15th here, so about 2 weeks ago from the time I'm filming this video. It is down a little bit on the day, and overall for the past 5 years it has fantastic dividend growth, raising that dividend every single quarter. You heard me right, not every single year, every single quarter. Sometimes it's fractions of a percent, but it raises it multiple times a year. It currently has over a 6% dividend yield, and WP Carey, like I said, has a very similar business model to that of Realty Income, and that they own net lease properties. And one thing that I love about WP Carey that's a little bit better than Realty Income, while they don't have as long as a track record, WP Carey is highly diversified, even better than that of Realty Income. They're mixed up between office space, agriculture, industrial, retail. They're even in multiple countries, and they have very high investment grade properties, and I think they will be wonderful for the long term. Microsoft is a net company that we own. We are up 32.01% on it. It has about a 1% yield. I said I only have about 3 or 4 companies in the portfolio that are strictly focusing on growth to get me a little bit of share price gains, and meanwhile get some small dividends in the meantime. Microsoft and Apple are the other two. Microsoft is the one that we're looking at right now. It has about a 1% yield. It has a great growing dividend every single year. I think Microsoft is going to be a stock that every single person wants to own in their portfolio, regardless if you're a dividend, a growth, or dividend growth investor, which is why I just have to own it. It's in the $1 trillion club. $1.6 trillion is the value of this company. That is absolutely ridiculous, and you can see how the share price has done over the last 5 years. Absolutely incredible. One of the best performers in the entire stock market. Now, Whirlpool is one of the best performers in my portfolio. We are up 59.93%, and it is only 3% of my portfolio. And Whirlpool is a stock that I thought when it was recession time and when the March lows were setting in, I thought that it was extremely undervalued, and the share price has basically just traded a little bit down for the last 5 years, while the growing dividend has increased almost every single year. They have about a 4% yield, even with the massive share price gains that I've got from this. When I bought it, I believe it was over a 5% yield. But Whirlpool basically just makes basic appliances. If you have a basic white washer and dryer or a dishwasher or whatever, a lot of your appliances in your home are probably produced by this company, Whirlpool. If you look into the company, the financials are solid, the management team is solid, and while the revenue growth is extremely slow, I think in share price gains, it will very much lag the market in the long run, but the dividend yield and dividend growth will exceed that of its share price. So in a long-term dividend growth story, this is a stock that you want to own. So Whirlpool is one that I intend on holding for the long term. Next up, we have Discover Financial Services. I believe it's the best performing stock in the portfolio. We're up almost 72% on the stock. It is also 3% of my portfolio. And Discover Financial Services, pretty much from the moment I bought the stock, it has went straight up. When we bought this stock, I believe it was somewhere around $29 a share. Or here we can see. I own it, $29.81 a share is what we own the stock at. So we owned it under $30 a share, and it is now over 50. And I believe at one point, it was actually over 60. So we were actually at a double up at one point when it peaked the other day. But Discover Financial Services have been growing its dividend, and one of the reasons why I love Discover Financial Services, and that is at a very high growth stage compared to a lot of other financial companies. And there's also a bit of a bias towards this company because I absolutely am in love with their credit card services and overall just their platform in general. I think a lot of people will love their services just like I do as a consumer basis, not only as an investment basis, and their stock price will in the long run be reflected on that. But I think that this company is just great in the long term. And while I do think that its dividend does have some pretty high risk, I think that it will be able to maintain that dividend throughout this recession. But if I'm wrong, I still love the company and I do have some massive share price gains that I can sell out of. Next up, we have Kimberly-Clark. We're up 10.29% on. Once again, 3% of my portfolio is what this stock makes up, and it is about a 3% dividend yield. It is up 27.27% in the last 5 years, and Kimberly-Clark makes your basic toilet paper, paper towels, a lot of just general consumer care that a lot of people need, that a lot of people look at as necessities. So it is extremely old and it is not going away anytime soon. And if anybody knows, people were buying plenty of toilet paper in this recession, if that's anything that we learned, and they are growing that dividend every single year and they're due for a dividend raise in a couple of months. But next up in the portfolio, we have Proctor Gamble, a very old, safe dividend company. We are up 7.34%. Also makes up 3% of my portfolio, about a 2.5% dividend yield. While the dividend growth is slow and the dividend yield is okay, and the growth of the share price is pretty moderate, this is the safest dividend company that you could probably own in the entire stock market. That and Johnson & Johnson. These two stocks, for every dividend investor, they need to have Procter & Gamble and Johnson & Johnson every single time. Excellent dividend growth, excellent share price growth, and in the long run, once again, they make a lot of basic appliances for a lot of personal care like toothpaste and shampoos and lotions and just a lot of things like that. You can read the description here if you're interested. But I think in the long run, Procter & Gamble is an easy win. It's free money if you're willing to invest in it for the long term. Next up in the portfolio, we have Waste Management. Waste Management is a company that is transitioning from a bit of a growth story to a dividend story. You can see the share price is up 114% over the last 5 years. The dividend has pretty substantial dividend growth from 39 cents up to 55 cents. It has a 2% yield, and I think they're focusing a lot less more on growing the company and transitioning more to giving more money back to shareholders, which includes that dividend yield and share buybacks. I think Waste Management is one of the easiest monies in the stock market, like a Procter & Gamble, in the sense that everybody makes trash and Waste Management is always going to be there to keep it up. They have very sticky customers. A lot of times when they get customers, they usually keep them for decades, not 1 or 2 years or a couple of months. They usually keep companies for 10, 20, 30 years that they will get revenues from, and I think Waste Management is going to do great for the long term. Waste Management is one of the largest holding by Bill Gates, and I think that it is an excellent company to hold for almost any growth or dividend investor. Next up, great for dividend investing, is Johnson & Johnson, like I mentioned. Procter & Gamble and Johnson & Johnson are two stocks that pretty much every dividend investor should hold. It's up 1.95% in my portfolio, and it makes up 3% of my portfolio in total. And Johnson & Johnson is up 40.13% over the last 5 years, and it has went from 75 cents, and they just raised again up to $1.01. This is a long-term story. 2.71% on the dividend yield, and it has an excellent track record of growing their company. The management is impeccable, and I think that in the long run, this will do excellent, just like most of these companies that I own. Next up, we have Store Capital, the new addition to the portfolio you can see on June 15th, just like WP Carey. And speaking of WP Carey, These are extremely similar business models. Now, one of the reasons why the stock has been hit a little bit harder compared to that of Realty Income and WP Carey is that they're primarily focused on service-based industries. Now, I don't know why there's a little gap here. They did pay dividends. I don't know why there's a gap. I think M1 Finance is having a little bit of issues, but it is growing that dividend every single year. And I think Store Capital, the way that they analyze their company, they use one thing that WP Carey and Realty Income does not, and that they strictly base their decisions off the financials of a company rather than the credit rating. So it's a little bit of a different take than that, but it is a very well run net lease real estate company. And I think that the growing dividend and the share price growth, with real estate prices always going up in the long term, this company will do just fine, just like Realty Income and WP Carey. Next up, we have one of the best performers in the portfolio, one of the child darlings in the stock market, one of the $1 trillion club, the number one company in the world. I'm up 49.26% on. It has a 0.85% dividend yield. They just increased that dividend this quarter. We're talking about the $1.6 trillion company, Apple Incorporated. Apple is a company that you all know. If you're watching this from a MacBook or if you're watching this from an iPhone, they're the ones that created that product that you know. You all know this brand. It is arguably the most valuable brand in the world. Apple is an excellent company to own, and you all know how its products work. And I think with Apple, with its credit card services, with its services in general, with Apple Music, and a lot of other consumer data areas that they're getting their products from, the 5G technology that will be coming out this year or next year, I think that Apple is a long-term growth story for both their dividend and their share price. Now, Honeywell is a company that I own. It makes up 2% of my portfolio. We are up 9% on it. And Honeywell has a great growing dividend for an industrial company from 52 cents all the way up to 90 cents a share in the last 5 years. It's up 38% in the meantime and has a 2.4% dividend yield. Honeywell is very similar to that of a 3M in the sense that they create thousands of products and they are very well diversified and are able to hold up through pretty much any recession. And you can see that 3M at 15% performance and Honeywell at a 9% performance are very similar, except the dividend growth is a little bit faster than that of Honeywell, but they do not have as long as a track record. So if you're interested in great long-term growth stories for industrial companies that have a lot of dividend growth, Honeywell is the one that I'd recommend. Next up, we have Qualcomm. We're up 35.58%. It makes up 2% of my portfolio. And while the dividend is okay and the share price performance is okay for now, this is a stock that will explode for 5G. This is probably not a stock that I will hold till I retire, but I'll probably hold for the next couple of years as 5G revolutionizes this technology that this company uses. They provide microchips and a lot of other hardware and software for companies, their number one customer being Apple. Similar to that of a Broadcom, this company will benefit massively from 5G, and I think that the share price gains as well as the dividend growth will be huge over the next 5 years. Next up, we have Dominion Energy, a very safe utility company, very similar to that of the Southern Company. Dominion Energy is a very long-term growth story. It is up 16.04% in my portfolio. It makes up 2% in my entire portfolio, and it currently has a dividend of 4.5%. It is up 22% over the last 5 years. And just like I said with Southern Company, buying the stock and getting pretty much guaranteed returns, while the returns will be slow, it is almost a easy money in the stock market buy. It has a 65-cent dividend 5 years ago and is now up to 94, so about a 50% increase, and the share price is up 22% in the meantime. So if you're wanting to buy a stock that will hold very steady in recessions and bull markets and will just gradually go up, Dominion Energy is one that I would recommend owning, very similar to that of the Southern Company. Next up, we have NextEra Energy Partners. Now, a lot of people have been asking me why I own NextEra Energy Partners over NextEra Energy, and it's basically just because I am not too familiar with energy companies, and I want to own this one because they have a higher yield than that of NextEra Energy. They are a spinoff of NextEra Energy. This is NextEra Energy Partners. They have a growing dividend every single quarter rather than every single year. You can see the growth there is incredibly high, and they are up 20.98% over the last 5 years, and they have almost a 4% dividend yield. Those of you that don't know, NextEra Energy is primarily focused on renewable energy, and they're not focused on like oil or any old fossil fuels or anything like that. They're primarily focused on things like solar energy and stuff like that. So in the long run, NextEra Energy is going to do excellent, and they're the only energy company I have in the entire portfolio. Now, Verizon, we're technically not down or up on it. From the moment I'm filming this, I am dead even. So it is 2% of my portfolio. Verizon is very similar to that of an AT&T. They're just financially a little bit healthier. They're 4.5% yield. They're up almost 13% in the last 5 years. And Verizon is just a basic play The growth for share price will not be very high, but the dividend does grow every single year. I think this is one that you just want to compound shares very quickly with, and is very similar to that of an AT&T. But Verizon is one that I intend to hold for the meantime, and we'll see what happens with that stock in the next couple of years and the next couple of months. For stocks that are at risk of cutting their dividend, Altria is up 9.86% in my portfolio, by far the highest yielder in the portfolio, 8.5% dividend yield, and it does grow that dividend every single year from 57 cents all the way up to 84. They are due for another dividend raise this coming month, so we will see if they raise that dividend next month, but they are down about 20% in the last 5 years. They're a tobacco company providing vapes, cigarettes, cigars, a lot of areas like that that a lot of people consider tobacco products to be negative, but Altria is one that you can benefit its massive dividend from if they're able to hold that up this recession. We will see. But Altria has lagged the market, but its dividend is just too massive to not take a chance on. Next up, we have Home Depot. 37.59% is what we are up on it. It makes up 2% of my portfolio, and Home Depot has a 2.25% dividend yield, and the growth has been quite substantial at 117% in the last 5 years. The dividend just went from 59 cents up to $1.50, so almost triple in the last 5 years. So substantial, incredible dividend growth, just like that of the Lowe's. Lowe's and Home Depot have very similar business models and very similar performance because people have been purchasing things for their home projects with the shutdown happening at all-time highs, and this is benefiting Home Depot massively. I'm sure that next year the dividend raise for this company will be quite substantial next year as well. So Home Depot is one that I love. I probably should have bought a little bit heavier than 2%, but oh well, we'll see how that company does in the long term. Cisco Corporation. So Cisco is a company that delivers food to thousands and thousands of different restaurants. You can read its description right here and how dominant it is in different areas that it delivers food from. Cisco is a dividend aristocrat. They've been paying dividends for an extremely long time. They raise it every single year from 30 cents up to 45, so a 50% increase, up 46% even with this recession. They have been hit a lot harder than I thought they would when this recession hit. Still a 3% dividend yield, and I think in the long run, Cisco will do just fine. JPMorgan Chase, one of the only banks I own in the portfolio, and JPMorgan is a stock that I considered buying heavier in this recession. Its share price has not held up very well since this recession hit, like a lot of financials, but the dividend growth and the growth in share price, it is the better run banks out there, in my opinion. Bank of America and JP Morgan are the only two I would consider adding, and JP Morgan is one that I added, and Bank of America is another one I'm considering adding. Overall, JP Morgan is a very well run company, and I don't intend on selling in JP Morgan no matter what. I probably intend on owning this company even if they were to cut their dividend, but IBM and AT&T are the two that I did lower my position in. You can see the massive drop off in share price right there when I sold about 3/4 of my position on IBM. IBM does have a massive yield, but it really questions me with the decisions they made with management, their struggling business model, and the slow dividend growth and the massive debt they have hanging over their head. I don't want to sell out of them entirely. I will keep 1%. Overall, IBM is a company that I think is at a huge risk with this recession. We're up about 8.6% on it, and it does make up 1% of my portfolio. And the other stock that makes up just a measly 1% of my portfolio is AT&T. We're up 7.23% on it, and in the last 5 years it is down 18%. It has went nowhere in decades as far as share price goes. Now they have been able to keep that dividend yield, so that is what is important for me. They have grown that dividend, but it is extremely slow. They have massive, massive debt piles over their head. But the main thing why I've sold out a big chunk of AT&T is the management decisions and their business model as a whole. With their recent purchases through DirecTV and Warner Media, I think that they are going to struggle a lot. And if I were to guess, they have a good chance of cutting that dividend in this recession. But hey, I guess we will see. I think AT&T dividend cut is inevitable. But overall, guys, that makes up the entire portfolio. Thank you guys so much that have watched all the way to the end. If you want to see one last time, this is an update for my annual income, my monthly dividend income, and my portfolio value from June to the month of July. We'll be updating these numbers next month. If you made it all the way to the end, go ahead and use this link in the description. Be the 17th person to use this successful referral link. Go ahead and get dividend investing in your portfolio. Get it started with M1 Finance. You can get $10 just for signing up. And if you want to check out the other links in the description, they are in there as well. But thank you guys so much for watching. If you have any questions for me, go ahead and leave some questions down in the comment section. Email me directly if you need to, and go ahead and let me know any questions you have about the market or any individual stocks. But thank you guys so much for watching, and I'll see you next time.